Diving into the stock market can feel overwhelming, but understanding the basics is the first step to becoming a confident investor. Whether you want to grow your savings, plan for retirement, or just get started, knowing how stocks work, what moves their prices, and the risks involved is essential. In this quick guide, we'll break down the fundamentals every beginner should know, so you can start investing smart and make your money work for you. Today we will talk about stock market basics, what every beginner should know. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is the stock market? The stock market is a marketplace where investors buy and sell shares of publicly traded companies. When you buy a stock, you're purchasing a small ownership stake in a company. These shares are traded on stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ. The stock market plays a vital role in the economy by enabling companies to raise capital for expansion and operations through initial public offerings, IPOs. It also provides investors with opportunities to build wealth over time through price appreciation and dividends. The stock market's performance is often seen as an indicator of economic health, with rising markets reflecting optimism and growth, while falling markets can signal economic trouble. For beginners, understanding what the stock market represents and how it functions is the first step toward becoming a confident investor. 2. How stocks are traded. Stocks are traded through stock exchanges, which act as intermediaries between buyers and sellers. Trades can be executed by individual investors, institutional investors, or traders via brokerage accounts. When buying or selling a stock, investors place orders, either market orders, executed immediately at current prices, or limit orders, executed only at a specific price or better. The price of a stock is determined by supply and demand dynamics, influenced by factors such as company performance, news, economic data, and market sentiment. Trading happens during market hours, but some after-hours trading exists. Understanding the mechanics of stock trading, including order types, bid-ask spreads, and trading hours, is essential for beginners to navigate the market effectively. 3. Different types of stocks. Stocks can be broadly categorized into common stocks and preferred stocks. Common stockholders have voting rights and may receive dividends, but their claims on assets are subordinate to preferred shareholders if a company goes bankrupt. Preferred stocks typically have fixed dividends and priority over common stock in asset liquidation, but often lack voting rights. Additionally, stocks are classified by market capitalization: large cap, mid cap, and small cap, each representing companies of different sizes and risk profiles. Growth stocks focus on capital appreciation with high potential, but more volatility, while value stocks are typically more established companies trading below their intrinsic value, often paying dividends. Understanding these categories helps investors align their portfolios with their financial goals and risk tolerance. 4. Why stock prices change. Stock prices fluctuate constantly due to a variety of factors. At its core, stock price movements reflect investors' perceptions of a company's current and future value. Key influences include earnings reports, economic indicators, industry trends, geopolitical events, and market sentiment. Positive news like strong quarterly earnings or new product launches can drive prices up, while negative news such as missed earnings targets, scandals, or economic slowdowns may cause prices to fall. Market psychology, including fear and greed, also plays a significant role, sometimes causing prices to move irrationally in the short term. For beginners, understanding why prices change can help prevent emotional reactions and promote informed decision-making. 5. The importance of diversification. Diversification is a fundamental principle of investing that involves spreading investments across various assets to reduce risk. In the context of the stock market, this means holding stocks from different sectors, industries, and geographies. Diversification helps protect a portfolio from significant losses because the poor performance of some investments may be offset by gains in others. For beginners, investing solely in a few stocks or a single sector can expose them to unnecessary risk. Mutual funds and exchange-traded funds, ETFs, are popular ways to achieve diversification because they pool money from many investors to buy a broad range of securities. Building a diversified portfolio is a key strategy to manage risk while pursuing long-term growth. 6. Understanding risk and reward. Investing in stocks inherently involves risk. Stocks tend to be more volatile than bonds or cash, meaning their prices can fluctuate widely in the short term. However, stocks historically offer higher returns over the long term compared to other asset classes. This risk-reward trade-off means investors must balance their desire for growth with their comfort level with risk. Younger investors with longer time horizons can generally afford to take on more risk, while those nearing retirement often seek more stability. Risk can be managed through diversification, asset allocation, and regular portfolio reviews. Beginners should understand that while stock investing can be rewarding, it requires patience and a tolerance for ups and downs. 7. How to start investing in stocks. Starting to invest in stocks is easier than ever thanks to online brokerage platforms and apps. Beginners should begin by setting clear financial goals and understanding their risk tolerance. Opening a brokerage account is the first step, which can be done online with minimal fees. Many brokers offer educational resources, tools, and demo accounts to practice trading. It's wise to start small, perhaps with index funds or ETFs, which provide broad market exposure and reduce individual stock risk. Regularly investing through dollar cost averaging, buying fixed amounts periodically regardless of price, helps mitigate market timing risk. Additionally, beginners should focus on long-term investing rather than short-term speculation to build wealth steadily. 8. Common mistakes to avoid. Many beginners make common mistakes that can hurt their investment outcomes. Chasing hot stocks, trying to time the market, or reacting emotionally to market volatility often leads to poor decisions. Another mistake is neglecting to research companies or investment products before buying. Over-concentration in a single stock or sector increases risk, as does ignoring fees that can erode returns. Beginners may also overlook the importance of a long-term plan and discipline. To avoid these pitfalls, investors should educate themselves, maintain diversified portfolios, stay patient during market swings, and review their investments periodically. Developing good habits early on sets the foundation for successful investing over time. 9. The role of dividends in stock investing. Dividends are payments made by companies to shareholders as a share of their profits. Not all stocks pay dividends, but those that do can provide a steady income stream in addition to potential capital gains. Dividend-paying stocks are often seen as more stable, particularly those with a history of consistent or growing dividends. For beginners, dividends can be an attractive way to generate passive income and reinvest earnings to buy more shares, compounding growth over time. Dividend yield, the annual dividend divided by the stock price, is an important metric to evaluate income potential. While dividends offer benefits, investors should also assess the company's ability to sustain payments, as high yields sometimes signal financial distress. Incorporating dividend stocks into a portfolio can balance growth and income, making them a valuable component of a long-term investment strategy. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.